जॉर्ज, लेट्स प्ले वन वर्ड आंसर्स ओनली, ओके?
ओके।
आपको अपने एसआईपी से क्या चाहिए?
फार्म हाउस।
कब?
2030।
लॉन्ग टर्म सोच, नाइस। और शॉर्ट टर्म में?
हॉलीडे।
कहाँ?
जापान।
कब?
नाउ।
बस दैट्स ऑल।
गाड़ी।
वो तो है,
बड़ी।
मतलब लॉन्ग टर्म और शॉर्ट टर्म में जो भी चाहिए सब एक एसआईपी से मिलेगा। यू नीड अ म्यूचुअल फंड पोर्टफोलियो। हर लॉन्ग टर्म सपने के लिए एक एसआईपी इक्विटी फंड में, हर शॉर्ट टर्म सपने के लिए एक एसआईपी डेट फंड में। आदित्य बिरला सन लाइफ म्यूचुअल फंड इन्वेस्टर एजुकेशन। Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Conference is being recorded.
A very good evening to all, and let me begin by thanking each one of you for being here on this what promises to be a very power-packed webinar, because we have with us very esteemed panelists. We have Mr. A. Balasubramanian, MD and CEO, Aditya Birla Sun Life AMC, a stalwart of the mutual fund industry. He brings with him over 26 years of rich experience both in fixed income and equity. Ashish Shankar, Deputy Managing Director and Head of Investments, Motilal Oswal Private Management. His current responsibilities include managing family office mandates, products and research, financial planning and investment strategy for the wealth management business. He is also the author of the monthly research publication, Alpha Strategist. We have also with us Mr. N.S. Venkatesh, Chief Executive AMFI. He has over 3 decades of experience in the banking sector, including managing treasury and international banking. He was also the chairman of Fixed Income, Money Market and Derivatives, that is FIMDA, between 2011 and 2016. I'd like to begin I would like to begin the presentation by one of my favorite quotes. Before you are wise, after you are wise, in between you're otherwise. This kind of sums up the journey of investors in fixed income, in debt mutual funds over the past few years. If you just give me a second, I just wanted to share a presentation. Between 2014 and 2017, we had the retail participation in debt mutual funds increased very, very rapidly. This was due to a couple of reasons. One was, I'm sorry, the presentation is not getting shared. Just give me 2 minutes. Yeah, okay. So we are back again.
Yeah, visible. Presentation
it's
visible.
Okay, okay. Yeah. So like I was saying, this is a very, this has been a period where between 2014 and 17, we saw the retail participation in debt mutual funds jump manyfold. There were a few reasons for this. One was because these funds delivered very attractive returns. As you can see from the table, between 2014 and 16, the returns were close to 9-10% and even double digits. And investors started substituting debt mutual funds, and they started looking at them on par with bank deposits, and we saw huge flows coming into debt mutual funds. This was also the time when interest rates were on a downtrend. From 2014 to 17, we saw the rates coming down, and hence the returns were very healthy. This was also the time when post demonetization, there were huge inflows coming into debt mutual funds. And we saw that the participation was huge, returns, all the investors were happy, and that was a period that everyone was comfortable. And then the ILFS crisis in September 2018 happened, which kind of after that all hell broke loose, because the bonds of ILFS were downgraded very swiftly, and it impacted the returns of the debt mutual funds. And that kind of snowballed into a liquidity crisis. We had the DHFL fiasco that came in very shortly. And then we had all these other stress build up in the economy. We had ADAG, Altico. I mean, the list just kept running long. I mean, we saw one event after the other. And if you see, hence in the table, the 2019, if you see the credit risk funds, the returns were kind of flat. And you can also see how the retail participation just crashed in this last 1 year. And then, of course, we had the Franklin debt mutual funds winding up, which was like the last straw of the entire thing. And now investors, in fact, I'm very happy to say that we've got so many questions lined up, Bala, Mr. Venkatesh, and Ashish. We've had over 200 queries coming in, and everyone's, worried after the Franklin episode that whether it is really safe, to invest in debt mutual funds. So let us, this would probably be the broad structure which we can follow. So Bala, coming to you, I thought you could probably kick off the discussion, because if we get the basics out of the way, let's first understand how debt mutual funds perform, what are really the, what impacts really the returns, how the prices, the interest rate movements, credit risk. If we have a general basic discussion of how these things work, then we can move on to more critical issues. Over to you, Bala.
Yeah. Thanks, Radhika, for setting the momentum. I think in debt mutual funds, it's actually speaking, I've been part of the mutual fund industry for the last 29 years and seen debt market movements at all point of time. I think if one understands the fixed income, the way it functions, then one will have the more comfort to put money in fixed income schemes, keeping in mind I'm investing the money for long term. I think fixed income has got two components to it. One, of course, unlike in equity, in fixed income, the NAV movement goes against the interest rate movement. If the interest rates move up, the price fall, therefore NAV falls. The NAV, if the interest rates moves down, which of course happens today is of course happening, then naturally the price move up, the bond prices move up, and therefore NAV move up. So this is the function in which the movement of NAV happens in any of the mutual fund schemes. The second component which affects is the credit component. The same way when I buy a security which is a AAA today, the security AAA, say as I'm buying it, say a bond yield of say 8%, and tomorrow it will become AA plus, then actually its cost of borrowing from 8 will go to 9. So the moment the 8% goes to 9, naturally because of downgrade, then naturally the NAV will fall, and the price of the bond will go up, and therefore NAV will price of the bond will go down, therefore the NAV will go up. So this is the function that happens. Therefore, in the mutual fund industries, there is a 4 component which of course drives the. I'm not very sure you'll be able to see it. So the 4 components which drives this. Yeah, there's the 4 component. First component is the interest accrual. So at any point of time, the portfolio, when I invest in a fixed income securities, The fixed income has got the coupon that carries in the part of the securities. The coupon gets accrued every day basis. That drives NAV. And second is the monetary policy. Whenever I look at the monetary policy, Reserve Bank of India, whenever it rises interest rates, drops the interest rates, the price fluctuates, there's another component, which comes in a normal course. It comes in, say, 4 times in a year or 6 times in a year. Every 2 months now it comes nowadays. So every 6 months, every 2 months, you will see the RBI coming and actually intervening. Therefore, the price fluctuates. The third component is actually the rating upgrade and downgrade. Rating upgrade and downgrade is part of the normal course of the business. Today, you will find rating downgrade happening because the economic slowdown is happening. Probably you will see once the economic scenario gets better, you will see upgrade also happening. So this kind of thing also would lead to an increase in prices. The last component is the default component. So given default, whenever the default happens, naturally the potential price you will recover on such investment goes down quite significantly. So therefore, you will probably see a provisioning, something like what banks are making a provision for NPAs. The mutual fund also will make a provision in the form of price drop. This is the fourth component which actually drives the fixed income schemes. If you look at the order of the frequency that contributes to the overall NAV movement, the first component, the number one component is the interest accrual, happens every day. So therefore, the NAV will keep moving up in a linear manner. At the same time, something comes and actually affects the NAV, which is basically the monetary policy. That happens once in 2 months. Therefore, that doesn't happen every day basis. If the monetary policy remains flat, the price movement also remains flat. The third component is rating downgrade. Doesn't happen every day. Doesn't happen every day. It happens once in a while. Maybe in a year it may happen once. It may happen twice. Not even twice. It happens only once. And the fourth component is the default. Happens once in 3 years or 5 years. Therefore, if you look at broadly, if you understand the fixed income, while the NAVs will keep fluctuating, if one understands this concept of 4 components which drives the NAV movement of fixed income schemes, then the experience that the portfolio can generate to the investment of the lower, the longer, and actually is pretty good. In this context, I want to take one example, which is another example we want to take. If somebody has put, say, 8%, assuming I get about 8% return for 3-year period. And let us assuming over a period of 3 years, I get about 3 multiplied by 8, 24% is the 3-year cumulative return I get. I actually lose 8% of the NAV I lose, which is about 8% value I lose because of the default. Some securities have fallen, has become default. Some securities have fallen in price. So whichever way I take it, let us assuming 8% is my total loss in my return for 3-year period. It can come in one go. It can come as one NAV can fall in a single day. So if we knock off the 8% over a period of 3 years, so 24 minus 8, the 16% what I get over a period of 3 years period, which essentially means I get about 5.5% return. So though the NAV fluctuating is true, there's a loss of 8% also true. There is absolutely no denial on that. But still you will get about 5.5% return, which cannot be considered as a bad return in mutual fund schemes. And given the fact that fixed income schemes does deliver return in the long run, but there is a time like today where the ILFS crisis happened. It's a one-off event. And unfortunately, the one-off event remained the whole event prolonged for the whole period of 18, 19, and 20. Probably will remain in 21 also. But during this period, yes, some pain point comes in fixed income. But otherwise, if we take a longer period, fixed income, because the 4 components which I mentioned about, in that dominant component of the portfolio is actually the interest component. And that comes in, that comes as a savior in the long run.
Okay. Bala, would you like to kind of elaborate? Now we have, in spite of SEBI coming in October 2017 and kind of, streamlining all the mutual fund categories, we still have 16 categories of debt mutual funds. And investors often wonder which is right for them. It is still a huge number of categories. We have over 40 AMCs in the market. So it's a very difficult choice. So you wanted to discuss something about, how to assess the risk in each of these funds, these 16 categories?
Yeah, I think clearly, I think this probably I would give credit to SEBI for having forced the categorization of mutual fund schemes. I remember the discussion that we used to have that credit opportunities fund we used to call for the credit fund which invest in securities. which are below AA minus or below AA. Then with the insistence of SEBI, we change the name of the fund from credit opportunity to credit risk fund, which essentially means the name itself very clearly says that I will take credit risk below AA. Therefore, that comes with higher risk, higher return, and times like today, higher risk also, if it rectifies, then return also goes for it also. So that's only one segment of the portion of the mutual fund portfolio out of 15 lakh crore. The large proportion of the portfolio which investors can look at, the liquid fund, which invests only in overnight and is overnight or invest in a 90 days instrument. The beauty of 90 days instrument is every 90 days, whatever I'm lending, it matures. That means in a year, the security can get reinvested 4 times in a year. It can get every 3 months or every 2 months, it gets reinvested. Money comes back, it gets reinvested at the prevailing rate of interest. Again, money comes back, again get reinvested at the prevailing rate of interest. As a result of that, the money gets reinvested in a year 4 times or about 6 times. Just imagine somebody has put the money for 10-year period. The 10-year period multiplied by 6 times per annum, that 60 times it gets reinvested. Therefore, the interest rate risk is taken care, the liquidity risk is taken care, and of course, it gives you a return which is relatively mediocre return, but better than savings fund return. That's the treasury portfolio if you see. Within the treasury, if you take, there's a savings fund, money market funds, all of them actually target to invest in securities which are 3 months to 6 months to 12 months maturity. What does it mean? If it is 3 months, every 3 months get reinvested. If it is 6 months, every 6 months get reinvested. If it is 12 months, every 12 months get reinvested. The higher the reinvestment, the lower the risk. And that's the way one has to see it. The higher the reinvestment, also has got a risk of the return can move up and down. As today, the interest rate is about 4%. As per RBI repo, 10-year bond yield is about 5.5%. Therefore, the reinvestment happens lower rate of interest. But when the rates are high, the reinvestment happens higher rate of interest. Therefore, predominantly from investors' point of view, they have to choose between a treasury schemes, which takes care of investors' risk, investing only in securities which are less than 1 year maturity, and quality credit, which basically invest only in banking and PSUs companies, banking sectors, or invest only in public sector companies. The corporate bond fund, which invests predominantly AAA and high quality securities that also invest between 1 to 3 year period. And the other securities, we leave aside this center portion of the portfolios. Then other schemes such as credit risk fund or medium term plan or short term opportunities, all such schemes would try to generate a little extra return by going down the credit path or going down the longer duration. The moment you go for the longer duration, one has to assume there is an element of risk they are running. If you don't go down the credit curve, say from AAA to say the large proportion of the portfolio is concentrated towards say A plus or A minus, then there is an element of risk they are running. As long as these two layers, from investor's point of view, don't want to take the risk, and predominantly you want to be conservative. At the same time, you want to generate reasonably predictable return. Then stick to your investments between the treasury and quality credit kind of portfolios, and that will take care of the 75 to 80% of the requirement of the customers. And those who want to get extra return, at the end of the day, everyone has got element of fear, element of greed. And when you take care of actually investing in treasury and quality credit, the mid segment of the portfolio, it does not have the fear, does not have the greed. At the same time, some element of greed if you want to bring in, I want to actually generate a little higher return. At the same time, I want to remain only in fixed income schemes. Then comes as the credit risk fund. And over a period of time, credit risk fund on a 5-year period, 10-year period, or maybe a long duration funds, and over a period of 5-10 periods can generate good return. And that's the way I think one has to look at it. So one of the assumptions I always take, this is the way I think the risk has to be maintained. So I think lower the risk overnight fund and lower the return. I think we take a liquid fund, little lower the return and lower the risk. And if we keep moving up, I think the funds which are gilt fund, income fund, there are long duration funds. I mean, some of them actually long credit, higher credit risk they take. Therefore, the risk is high, the return is also high. So one of the things that I need to also mention, you need to also look at this from a period point of view. The longer the period, higher the curve when you go, you have to also increase your holding period. I think most of the people, I think when they say they come for 1 year, 2 years, and then say, I invested in credit risk fund, I'm actually suffering. Or they may probably say that I invested in a long duration fund and the 2 years not given return. At times, it may go through ups and downs. The same thing if I keep it for the longer period, the experience can be good only because of one component which I mentioned about the interest accrual component contribute to the higher proportion of the NAV movement on a daily basis. I want to just give one example of our own fund, which is Birla and Complex. We don't generally recommend. It's not recommended by any of the advisors. It's also not being bought by any investors on a continuous interval. This fund has seen a lifetime of almost about 25 years. I myself used to manage money in the early 90s. This fund has seen all the ups and downs, the four components I mentioned about, which is the RBI fluctuation of price movement led by RBI movement, which is the monetary policy, rating upgrades and downgrades, defaults. All these components have seen the fund has generated about close to about 8%, 8.3% return on a 25-year period. But this period, believe me, yeah, I have seen interest rates coming down to 5% for 10-year, and 10-year yields went up to 11.5%. Despite such a huge swing, the fund has managed to give such kind of return because of one component, which is interest component, and the money managers, of course, play adjusting the portfolios on a regular basis in order to protect the investors.
Okay. So I have this very pertinent question which has come across, we've got from so many people, and I think I would like to address this to Ashish because you are from the investor community, and I'm sure that now that Bala has given a full perspective of, we have interest rate risk, we have credit risks, and based on the risk appetite of investors, now they need to position their portfolio across these 16 mutual funds. Now I'm straight away coming to the issues because we have a long list of questions from participants on around these issues. So we know that we can assess the credit risk to some extent because if you look at the portfolio, we have AAA rated, we have AA rated. So if you're not comfortable with the lower rated bonds, then you can stick to corporate bond portfolios like Bala was mentioning, or banking and PSU debt fund, and so on and so forth. But if you look at these points that I have just put in, and just for a quick, ILFS was enjoying top-notch ratings, right? And it was suddenly downgraded to default, and then we saw debt fund investors taking a huge hit on their returns. Then we have the portfolio which has all these complex instruments, right? We have SPV, like ILFS, SPV, the names were not known till the issue cropped up, right? No one knew the backing was ILFS. Then you have structured obligations, you have credit enhancement. Then we had the AT1 bond issue. All of this we'll discuss in depth. But when the portfolio is so complicated, the questions that we have also been raised by our readers, how do we assess the quality of the portfolio?
Right. Thanks, Radhika. I think Bala pretty well captured the entire mutual income space. If demonetization was the moment for digitization of payments, I hope this is the moment for people to understand diversification and asset allocation. At the end of the day, every crisis, and I'm not talking about a correction, you have a crisis once in a decade. You had the global financial crisis. Today, we have this pandemic. You had the dot-com bubble burst in 2000. Every crisis brings up certain risks that you didn't expect. See, what happens is the regulator or even fund managers, they can model for risks which are incremental. But it's very difficult to model for risks which are disruptive. So I always believe that regulations always follow risk. So in 2009, for example, a lot of FMPs put a cap on the amount you can redeem. So they started redeeming small amounts every day. And that was the time when FMPs became close-ended and mutual funds had to compulsorily list FMPs. That took away the sudden risk of liquidity away from FMPs, right? I think in this time, SEBI has been slightly ahead of the curve when they started classifying mutual funds into different categories. So they've already made things easier for the average investor by classifying funds into credit risk funds or income funds, PSU banking and debt fund. The moment you see the name, you know what kind of instruments the fund house is going to invest in. For example, if it's a short-term fund,
Okay.
you know what is the maturity of the underlying papers. There is a restriction given by SEBI, right? Of course, the Templeton problem happened because even in some of the lower duration funds, they were carrying papers which were lower rated, right? And this freeze in liquidity resulted, and the redemption surge resulted them in putting a cap on redemptions. I'm sure SEBI will come out with a revised set of guidelines, and I'm sure Bala and everybody, AMFI, is actively involved to make the reading of mutual funds even simpler going forward for clients. So that is one. Second point, Radhika, is that when you're investing, there are different ways to invest. You can either directly go and make your investment in bonds or fixed deposits, or you can do it through mutual funds. Okay. I know a lot of investors who've gone and bought, let's say, an ILFS bond directly. Now, when you buy the bond directly, you are subject to a minimum amount that you have to invest. Or let's say, I know a lot of retirees who've gone and bought the 81 bonds of Yes Bank, right? Now, what happens when you go and buy individual instruments? Each instrument has a minimum amount. So you end up investing a fairly large part of your portfolio in those instruments. And when some crisis hits, a large part of your portfolio becomes zero. Okay. Now contrast that with mutual funds. I think broadly, a lot of mutual funds have sidestepped some of the challenges that we have seen over the last 3 years. But even mutual funds who've held some of these papers, if you look at the return on a 3 to 5 year basis, like Bala was saying, even on a 3 to 5 year basis, if you have 8% of the portfolio going bad, or let's say 3 or 4%, you still end up with a positive return of 4 to 5%, right? Now contrast that, let's say if you had put 10% or 20% of your portfolio in a 81 bond of Yes Bank or ILFS. And I know, by the way, I know people who have invested directly in some of these bonds. The losses on your portfolio would be significantly higher, or probably you would be sitting at a capital loss at this point in time, even after 3-4 years. So I think what investors must appreciate, that diversification component that you get from mutual fund cannot be replicated by buying direct instruments.
Okay.
Lastly, but not the least, Radhika, I think as SEBI and AMFI are working to make reading of mutual fund names and portfolios easier, today an investor can see the name of the fund. Let's say, for example, if it's a short-term fund or a PSU banking debt fund, at least know how safe is the underlying fund. The moment you see credit risk, you should be wary, right? You should be wary in the sense that, hey, this fund is trying to generate an extra return, okay? But at the same time, they are generating that extra return by buying papers which are lower rated. So there could be risk of a default or risk of a write down in part of the portfolio, right? If you see that 80-90% of my portfolio, I'm going to diversify between treasury fund, ultra short-term fund. A large part can be in these 2-3 year PSU banking corporate bond funds. Now, these are funds which give you a return for the period that the fund is invested in. For example, treasuries are repriced maybe every month, right? PSU banking and debt funds are repriced every 2-3 years, right? So every 2-3 years, when they're reinvested, your interest rate gets reset as per the prevailing interest rates. And then, like Bala said, the gilt or the long duration funds, they have papers which are running into 5, 10, 15 years, right? There the volatility will be higher, but the volatility is not higher because of credit risk. They are buying the highest quality paper. The volatility is higher because any change in interest rate will move the price of the underlying debt instruments in a much bigger fashion. So I think what investors need to be cognizant of, Radhika, is when they're investing in the fund, they need to understand what they're investing into. They need to figure out what is the maturity of the fund and what is the yield to maturity. Now, often a lot of people get attracted when they see high yield to maturity. So the moment they see a 9% yield to maturity, they feel, oh, this is great. This is going to give me 9%. Now, to me, that is a red flag. Now, I'm saying red flag in a way that you need to understand what you're investing.
Why it is.
You still go and invest in that fund. But you may say, hey, this is 9% YTM. Investing in lower rated papers and making money. And hence, I'll probably allocate only 10 or 15% of my portfolio in these type of funds.
Correct.
So I think diversification, even within fixed income, becomes very, very important. And I'm still saying, for a lot of people who are putting their hard-earned money in mutual funds or any other kind of investments, just for your peace of mind, keep 10-20% in a bank deposit. There is no harm. First, you keep it in a bank, so you have that money at call any point in time. After that, you build a mutual fund portfolio, because putting all the money in a bank is also not a solution, Radhika, because there is a gentleman called inflation who's eating up your wealth every year, right?
Yeah, true, Ashish. But I think I need to interject you here, because it's true that debt funds are a very critical part of one's portfolio, because they offer stability in returns, and it is very important to have that in your portfolio. But I think the concern now, and I want to take this over with Mr. Venkatesh, since you have been very much involved in the bond market, the way it has been developing over the last so many years. You know that we have taken so many efforts to broaden the bond market, and much of the issue that we are seeing right now, also the illiquidity with lower rated papers, is because the bond market is not vibrant. We still have a very narrow bond market. But I want to come back to the question that Ashish was talking about. For a retail investor, it is not really very easy to assess the risk, right? When you're saying banking and PSU debt fund, sir, we had this 81 bond issue. A lot of these funds were holding 81 bond issue, which is not very evident when I look at the fact sheet of the mutual funds. It's only when I dig in that I know there is an 81 bond, which has a case which can be completely written down in a yes bank kind of a scenario. So if you can tell us, sir, that how these kind of issues, these different complex instruments that debt mutual funds invest in, how can the retail investor at all understand structured obligations and all of this?
Thanks, Radhika. Essentially, I would have to say that our mutual fund industry is one of the most transparent industry in the whole world. The way that the fact sheets are put out, the way the daily NAVs are being put out, the way the daily AUMs are being put out, I think this is one of the industry which is very, very transparent. If you give your money as a deposit to a banking institution, I come from a bank, my earlier career was a banker, you don't get to know what is their portfolio, what is their NPA, nothing. But whereas here, at least the mutual fund industry clearly demonstrates that the money that you gave to me for investment is actually put out in these sort of papers, and on a monthly basis the fact sheets are being put out, the NAVs are on a daily basis. So I think transparency wise, I would say the mutual fund industry is far ahead of even the global industry, the Indian mutual fund industry. The rankings made by Morningstar Research very clearly shows that is the global research firm Morningstar has ranked India mutual fund industry as the #1 for transparency in the whole world. So I think we are not opaque as an industry. We are not opaque, but there could be things which could be looked into from the crisis that we are currently undergoing. Maybe we learned some lessons and we can try and do something better, but that is only a learning lesson. But otherwise, as an industry, the intent is to ensure that the information which is being provided to the investor is at the highest quality, highest level. Okay. So that is where it is. Now, how does the investor gain from this? The investor has to track his portfolio. The investor has to continuously track his portfolio. What happens is the investor generally relies on his financial advisor and gives the money, and after that then maybe he doesn't track it. So our submission is that the investor should track it either through himself or through his financial advisor's reports, and ensure that maybe while giving the money to the mutual fund, he chooses the right mutual fund which matches with his risk appetite. That he doesn't put money into a credit risk fund if he doesn't have that risk appetite to take that credit risk at all. Maybe the returns will be lower. Don't get that greed factor of getting a higher return. Go by what is your risk appetite and say that, okay, my risk appetite is safety of capital. So if safety of capital is there, then I can't go into a credit risk fund at this particular point of time. I would rather put my money in a liquid fund or an overnight fund where the capital is protected. So that at least I try and get a decent return, which may not be a very high return, but on an inflation adjusted basis or on a tax adjusted basis, my returns are superior to a bank fixed deposit. So then I put that money there because my appetite is only that. So it starts with the investor defining his risk appetite very clearly, and then choosing the right fund for his risk appetite, and then ensuring that he keeps on monitoring that portfolio of the mutual fund. I'm very quite clear that the mutual fund industry is very, very transparent.
Okay. Bala, then I have the question for you because I think we also spoke at the time all these series of defaults were happening, across fund houses. And you remember we also spoke when a lot of the FMPs, which were supposed to give back, maturity amount at that point of time, we had the ZESL kind of an event happening where there were some agreements made between the mutual fund houses and the corporates, giving them some more time to repay. And we saw there was a bit of a time lag in the way the returns. Of course, most of the groups paid back the money. But when incidents like this happen and, investors have this kind of a bad experience, though it could be kind of a short-term blip, when the understanding is that I just cannot understand where this new risk cropped up from. Like, for example, even in terms of, promoter loans, those bonds that were issued against, promoter pledge. And we saw equity market plummet and the, shares. So the cover came down completely. And there we saw a little bit of this. And we have seen SEBI now spruce up these limits, right? Now they mandate a 4 times cover and things like that. But for me as a retail investor, when I just look at the fact sheet, I'm only going by the rating, right? Rating is number one. So readers ask us that ILFS was enjoying top-notch rating. How did it get suddenly, downgraded to default? That is the first question. Then when you say SPV names, like I was mentioning to the Jharkhand and the Hazaribagh, we never knew they were promoted by ILFS till the issue cropped up. And same thing for 81 bond and all these promoter. So my question is that it's okay to say that you can go through the fact sheet, but has there been any change in terms of disclosure over the last 6 months, which can help investors understand this portfolio much better? Bala, you're on mute. You're on mute.
I think your observation is right. One, of course, as I mentioned earlier, the accidents in fixed income market happens once in 4 or 5 years. So like banking industries go through a pain all the time in the form of NPAs. And in the case of mutual funds, we go through this pain in the form of when market turns volatile, when the economy turns weaker, then naturally you will find some of these companies where the downgrade happens. In the case of ILFS, it's a company which has got 25 years of track record, has remained one of the strong financial intermediaries in the country for financing infrastructure sectors. Of course, if you tap the if you close the tap of money coming back in terms of refinancing, naturally anybody can actually get into default situations. And the ILFS case, of course, I still remember as an industry player, we all used to track it very closely. And some of the maturity which they had by themselves, and they can't get the refinancing, thanks to the Reserve Bank of India's one regulation that came, which introduced a new banking called PCA Bank. This is a Prompt Corrective Action Bank. The moment you tell the bank who has been in the business of lending for the last so many number of years, and suddenly you tell them that I don't want you to focus on lending, now you want to focus on more on improving your balance sheet. Therefore, you start cutting down all your lending from next month onwards. Then naturally the rotation of money gets disturbed. The moment rotation of money gets disturbed, our big companies, our well-rated companies will get into a trouble. So that I think is something is bound to happen. And that's what exactly happened post ILFS. The series of such event happens all because of that. See, promoter financing. Promoter financing is not a bad financing at all. Promoter financing is actually comes with a lot of security and cover in the form of shares. Of course, when the price fluctuation happens, naturally a cover gets reduced. But fortunately or unfortunately, mutual funds have been a part of the development of the bond market. Leave aside what is it I'm doing on behalf of the investors. But in general, if you look at the bond market point of view, the mutual funds have been a big player as one of the strong financial intermediary, along with banks, insurance companies, pension funds, and mutual funds have been a big player in the bond market.
Okay.
So they have been actually primarily playing the role of development along with the role of generating return for the investors. In this period, when we have taken a lot of initiative for development of the market, by identifying sectors in which we can actually give a financing, which otherwise not being done by others, and for which you are getting a generate extra return for the portfolio, then naturally you will actually jump into that. So that segment which has come, where it has come only in the credit fund, credit risk fund, all the structure, that instrument that you took the name of JARC and everything, they all were invested in those funds which are predominantly mandated to invest in securities, which are either structured instruments or promoter financing or some other instruments. There are fund houses who would have taken, of course, purely on the basis of the leeway. Every fund has got a leeway. From investors' point of view, you have to look at it that one, of course, the portfolio risk, the way I think the portfolio construction is done between AAA and various instruments. And nowadays, thanks to SEBI, we even disclose what type of instruments we own in the portfolio. Therefore, that disclosures will give you some sense of understanding the portfolio. Of course, there are many advices also will make you interpret how the portfolios have been constructed. But I think if you just keep the thumb rule of investing in, as I mentioned earlier in one of my slides, that the right from short term to a treasury portfolio to the short duration portfolio, which is a high quality focus in terms of portfolio constructions, that takes care of your 90% of the investment. I just want to give you one example. I think Venkatesh mentioned about tax adjusted return. I just wrote by hand just now. Let us just assuming one investor is also asking a question that why should I invest in mutual fund, go and give you 5% return. Instead of that, I'll go and put in a postal saving deposit. It's a good observation. I'm not saying no. So look at it here. Let us assuming we give about 5% return. The mutual fund generates 5% return. You hold it for a 3-year period. And then assuming inflation is your cost. Let us assuming inflation is 4%. 5 minus 4 is 1% extra return that they have generated. That 1% extra return, you have to pay a tax of 1%, only 0.2. That 20% of that gain, you have to pay a tax. There's a 0.2 is your tax. 5 minus 0.2 is a tax, is the return that you get, a 4.8% tax-free return that you get in a mutual fund for a period of 3 years. I'm just shifting this 5% 8%. By holding it for a 3-year period, eventually you'll get about 7.2% tax-free if you hold it for a 3-year period. Let us assume 10%, which is of course quite an unreasonable expectation in today's scenario. But still, if you get about 10%, even after paying 20% tax and excess return that you generate, over and above the tax extra return that you got about 6%, over and above the inflation of 4%, you still get about 8.8% return. So this is the beauty of mutual fund fixed income product. If you hold it for a longer period, tax return is very good, and that's something one has to look at it. From the portfolio point of view, while these accidents cannot be avoided, I think 2018 onwards, we have seen very tough period. Yes. And the last we saw in the credit market in 2008 was Lehman Brothers crisis. I must give credit actually for the MF industries during that period. They managed the portfolios quite well. Even in the period of 2018, 19, 20. So I keep taking this example. The industry managed about 15 lakh crore size. We as a mutual fund, as Birla mutual fund, manages close to about 1,50,000 crore size. In this, these investments that has got impacted because of credit movement is only in the credit fund. That's one. Second, if it is aggregate amount, the aggregate amount that has come under the attack, basically come under question mark, is roughly about 12,000 crores. Out of 12,000 crores, in the mutual fund, not all money is completely gone. It maybe your recovery rate could be 50%, 60%, or 70%. Is not zero. Therefore, as the recovery happens, then naturally you will get to gain. Therefore, we say from investors' point of view, the moment you panic on such situations, then naturally you take the loss and walk out. Whereas if you stay invested for a longer period, irrespective of whatever we may say, irrespective of whatever the market may say, irrespective of whatever advisors may say, because the 4 components which I mentioned about, the interest rate, interest accrual component is highest component of the NII movement,
Okay.
that comes as a savior in the long run.
Okay.
I think that's the principle. If I keep it, I think I'm sure investing in fixed income would become relatively easier.
Okay, okay. Thanks, Bala. Before I take the questions from the audience, because there are plenty of them lined up, I just thought I will ask a few more questions, because a lot of our participants are also asking questions on those lines. One is, of course, if I look at the portfolio now, given the COVID situation and how things have worsened in the bond market over the last 2 to 3 months, and I think we all agree that it will take at least a year's time, for the bond market to, at least for the lower rated paper, for some sort of a liquidity to come back. Now, if during this period, if I look at the concentration of most of the portfolios, they are very, very concentrated because of the fact that much of the risk has now, I mean, the concentration is now in low rated papers, because these funds, owing to redemptions, have already sold the good quality paper, right? And we also see that a lot of funds, aside from Franklin, have kind of very high borrowing limit, which is now a growing concern. We can probably discuss that a little later. So given this, what is going to be the outlook for the next 1 year for people stuck in these funds, which are not necessarily credit risk funds? These are also low duration funds. Some of them are short term funds. Some of them are FMPs. The portfolio looks really very, distressed at this moment. And many of these funds have segregated portfolio, which hold, which have holdings in Vodafone and things like that. So, Ashish, if you could start off, and then I'd want Mr. N.S. Venkatesh to address these two issues that we've constantly been, okay, this has all happened, and I should probably in future look at all this risk, but now I'm stuck with these funds. And for the next 1 year, the bond market doesn't seem to be going anywhere for these low-rated papers. So what can I do?
Right. So Radhika, to be very honest, it's a tough situation because next 1 year the economy looks quite challenging, right? Now there are two things. One has to assess what is the overall allocation of the portfolio in these kind of funds. If the investor has still remained invested in these funds,
Okay.
If it still continues to be a reasonable amount of allocation, right? If it's 20, 25% or 30%, I think regardless of the potential for return from these funds, the investors should reduce risk, because I always say that there is no bad time to reduce risk.
Yeah.
Okay. But at least I hope for the future, these investors are better equipped. And here again, I will reiterate that, it is definitely useful to use an advisor to make your investments, because like you rightly pointed out, reading a fact sheet, structured paper, 81 bonds, there is a lot of things that investors have to understand before they make their investment. One part of it is very good, that MF industry is very transparent. So you have everything in front of you, but how do you decipher it? So it helps to have a good advisor on your side who can help to do this. The second part of your question, which is some funds have side pocketed.
Right. Right.
Now, all may not be lost for all the side pocketed investments. Although the mutual fund has written it down and side pocketed, for even investors who exit today, the side pocket continues to exist for them. So let's say you exit something, you have a fund which is side pocketed Vodafone or an ILFS, okay? And you exit today, right? The side pocket continues to exist for you. Okay. Let's say after 3 months, 6 months, 9 months, if there is some, Vodafone gets resolved, or let's say some part of ILFS gets resolved, that money flows back to you. Okay. So I'm answering it in two parts. One, if you have investments in these funds, you have to see what part of your portfolio is constituted by these high risk funds, right? Okay. If it's a small component, let's say I would define small as below 10%, then you can let it be, because a lot of these funds papers have got marked down heavily, and over the next, maybe not a year, but let's say over 18 months, 24 months, you could see reasonable recovery in a lot of these papers.
Okay.
Because alternative investment avenues have fallen now below 6%. The PSU banking debt fund yields have actually fallen to about 5.5, 5.75%.
Okay.
Right?
Okay.
There are no, so alternatives are also not that great. So you can let it, but let's say your portfolio is comprised almost of 25, 30%. It should not have been there in this kind of concentration, right? But if it is there, then I think even today you must reduce your risk and bring it down to maybe 10%. You take the hit, I understand that, but I think from a future point of view, you're better equipped to create a portfolio. And I think you must work with an advisor going forward. The other point I just want to make, a lot of people don't talk about it, Radhika, is people should look at the net YTMs. A lot of people publish gross YTMs. Now, what is the difference? Gross YTM is the yield on the fund, average yield on the fund of the under all the papers.
Okay.
There is an expense ratio that the fund charges. So the gross yield minus expense ratio is the net. Okay. So because net yield is what you get at the end of the day as an investor. So that's my advice, honestly.
Okay. We'll quickly now go to the Q&A because we have plenty of questions from the participants. Mr. N.S. Venkatesh, there is one specifically for you from Arunachalam Shivraman. He says that why isn't the government holding credit rating agencies accountable for their inefficacy in rating them appropriately? I think this question crops up time and again because that really is the crux of the issue. Like we said, investors say AAA rated, and then they say the fund is pretty safe, and they invest their money. So, your thoughts, sir, on this?
Globally, if you look at globally, the credit rating agencies are not held accountable for these sort of failures which happen because of market-led events or a credit crisis which comes on into the country. Okay. So if you remember the 98 Southeast Asian crisis was the first which we saw. Then the 2008 crisis, we saw the global financial crisis. So where the rating agencies are not held accountable unless and otherwise there is a malafide which was detected in the rating. In the normal course, whatever they are giving a rating on that, if something happens, they were not held accountable at all. But having said that, after this ILFS crisis and DHFL crisis and all sorts of things, SEBI has actually gone a step further and has prescribed accountability factors for the rating agencies, which is at a deviation from the global level. Globally, there is nothing. Whereas in India, SEBI has put its foot down and said the percentages of rating upgrades and downgrades, at least downgrades should not exceed a specified percentage. If it exceeds a specified percentage, then to that much extent, the rating agencies will be held accountable. So that is a big development as far as the rating is concerned in the Indian market, which we have not seen globally. So I think the regulator, we should pat the regulator on the back and say you have done a great job on this particular thing to bring a little bit of more discipline into the way the rating agencies function. And towards that, the rating agencies have also put forward their request to the regulators, saying that we need more information flow to come to us to take this accountability. So that has been facilitated by the SEBI, and now the information flow to the rating agencies are also much more at a larger level, because of which the accountability factor is being fixed on the rating agencies. So from here onwards, we should see a little bit better discipline in the rating coming up.
Okay. Bala, there are a lot of questions. I'll probably just read out the names, but plenty of questions on Franklin. And we have been getting personally a lot of mails from our readers. We have invested in Franklin funds and we are stuck now. Will it take so much time as 5 years? And so many questions. So we have from Srinivasa Ramanujam, we have from Xavier, we have, from Parmeshwar. Everyone is basically asking this one question, that what is the future of Franklin funds? Will it really take 4 to 5 years for them to get the money back? And can a fund house really do this? Can they wind up the funds, close the funds like that and not give any exit option to investors? That's what lot of people. I can't even read out the names. I mean, at least half 50 or 52 of the questions are only on Franklin. So if you could please address that.
Yeah. Of course, what they have done as per the law and the regulation. The regulation allows a fund to be wound up the moment they see illiquidity risk in their portfolio, and then the investors who know about the portfolio quality and they continue to redeem ahead of others. And in this process, the people who do not know to analyze the portfolio or the ignorant investors continue to stay invested. In order to protect the investors who continue to stay invested, and also and also ensure that they get a right valuation on the portfolio, closing down is an option which I think what Templeton has chosen cannot be argued as is a wrong move. Definitely is considered as a shock because a lot of people have gone and put their money. So therefore the redemption is not able, they are not able to redeem. Therefore the redemption is stopped. Therefore they are feeling the heat. There's absolutely no doubt on that. But the regulation provides such kind of things. Therefore whatever they have done within the law and the and second is the moment you see redemptions in the mutual fund industry, we have seen. Suppose the going rate is say 8%. Let us assuming for any securities, the going rate is 8%.
Okay.
That is a normal rate of interest at which one can sell this paper or buy this paper in the market.
Okay.
Times like today, when mutual funds are facing a lot of redemptions, the buyers withdraw from the market. That 8% becomes a 10%, 11%, and then they start any kind of rate that they can quote. At that price, you are forced to sell the bonds. So the Templeton has taken the call that instead of making a desperate call, rather realize as much as possible for the investors by selling, by closing down the schemes, and then selling the securities, liquidating the securities, and give it to the investors over a period of time. The question is not about 4 years or 5 years. It's a question of the underlying portfolio. The way I see it as a practical person, as a market practitioner, as a money manager, the way I see it, each of the portfolio that they have will be liquidated in an orderly manner. They will liquidate, they sell the securities in the market at the price at which they can sell, which they feel is right, so that they realize minimum loss for the investors. At the same time, recognize some of the securities they can never recover it. Let us assuming some of the securities are gone for toss because of the COVID issues, and therefore the recovery prospects are not there immediately. Make a provision for such kind of investment and the form of evaluations, and then whatever is left out, I think you pay to the investors. This, in my view, the process would take ranging from 3 months to 6 months. But the way I see is an overall portfolio, not all portfolios will be bad. 100% of portfolio will be bad. Let us assuming some portfolio, percentage of portfolio got stuck. By any chance, because I have not seen the portfolios fully, therefore it's not easy for me to comment on that. Let us assuming 10% of the portfolio, 20% of the portfolio got impacted because of COVID-related issues. That may not come actually immediately, but rest of the portfolios can get liquidated, the money can come. So they are now in the process of having now gone under the lock-in of not paying any redemptions. Then they need to assess it and liquidate the assets, realize the right prices as far as possible, and then give the money back to the investors in stages. I mean, that's the beauty of liquidation process of mutual funds. Portfolios is known to you, and then it's only a question of selling the securities either to the promoters back or in the market whoever the right buyers are there. And as they liquidate, you keep paying the investors in stages. And that, in my view, could be the roadmap that one could expect from Franklin Templeton schemes. And therefore, investors, while the anxiety will remain, no doubt, because the money is stuck, you need some money to be received for some emergency. For such kind of things, yes, you will have some difficulty. I'm not saying that. Reserve Bank, the SEBI has also enabled such kind of scheme. The schemes of these 6 schemes are also enabled to be listed in the stock exchange. If somebody is able to find a buyer for these kind of units, say at a discounted price to the current NAV, then one can even buy these securities on the hope that they will be able to recover this money from as and when the Templeton is able to pay and get this money. This is normally an open-end fund. You cannot give the securities from one person to other person. You can't sell it. In the case of Templeton, SEBI has come with a special provision of listing the security in the market. Investors who are holding this instrument, they are able to find a buyer who is willing to help the seller because there is an emergency, or at the price below the NAV price can also be done as long as they are able to draw comfort on the way the roadmap will work.
But Bala, don't you think this is a little too late in the day? At this point of time, do you think there will be any liquidity? Listing is fine, but do you think there will be immediate liquidity for these securities? It should take another 1.5 years easily, given the market situation.
No, I think the way I see is the liquidity in the system is very large. I think if you look at the banking system, thanks to Reserve Bank of India, they have cut the interest rate so much, they are pumping so much of liquidity. Close to about 7 lakh crore or 7.5 lakh crores is going and getting deployed at the RBI window at 3.25%.
Okay.
From the bank's point of view, there's choice like this. Either continue to go and make the investment at 3.25% Reserve Bank of India, or come back to the market to start buying securities which are available at a very good deal, or go and lend to the market who are in need of money. In my view, is next 2 to 3 months, you'll see the second one which I'm saying is happening. Even the finance ministry has taken enough steps to give you a first-class guarantee to the banks for increasing the lending activities. When the money starts coming on rotation, then naturally you will find the secondary market trading picks up, and that actually will provide the liquidity for the secondary market buyers and sellers. Therefore, they will be able to liquidate the assets. So only those instruments which are structured in nature, which are lent to the promoters, whereas the promoters at this point of time, because the stock price has fallen, or maybe the promoters and business is actually not doing well, probably it could have some kind of issues. But otherwise, the way I see it, 60 to 70% of the portfolios may find buyers in the market as the time progresses. Therefore, I don't see they will take such a long period of time to liquidate the assets, except the assets which are unique to them, which are unique to the market, and such kind of instruments, they need to get into bilateral negotiation with the borrowers and then trying to find an exit.
Okay. We have one other question. I think Ashish, you can take this. Basically, this is Mr. Lakshminarayan from Delhi. He's asking two very critical questions. One is that the government and the RBI is pumping liquidity into the market, and the government will have a huge fiscal deficit. Do you see interest rates going up? If so, is this like a good time to invest in debt funds? That is the first question. And the second question, of course, is related to the Franklin, that is the comfortable liquidity in the debt market, is it illusionary, and could it vaporize in the coming months? Maybe your perspective, as Bala has spoken about the bond market, on these two, the interest rate and probably even the liquidity or the credit risk. If you could just sum up what you are advising to your clients and investors.
Right. No, these are very good questions, honestly, Radhika. So let me take the first one. You have to also understand what kind of environment we are living in. So it's not just that India's fiscal deficit is going to rise, right? Yeah. Globally, there is a concerted action to reduce interest rates and put liquidity into the system to alleviate the pain of the borrowers. Because what is happening is, because of this pandemic situation, a lot of businesses are shut, or they're operating at very low utilization levels. Correct. And anybody who has borrowed, this is a death knell for them if it continues for too long. So what all the central bankers are trying to do, or the governments are trying to do, is they're trying to put a lot of liquidity into the system to ensure that this liquidity risk doesn't result in a solvency risk. And a lot of businesses don't go down under, right? So I think the Indian government is also treading a similar path. Like Bala said, they've done a lot of monetary action, right? There is about 8 lakh crores which is being parked in reverse. In fact, the interbank borrowing is now happening even below reverse repo. So if you look at liquid funds, they're actually giving below reverse repo returns, right? Okay. On the other side, the government's finances are also challenged. GST collections have fallen by almost 60-70% per month. So it's natural that this year the fiscal deficit will widen. But most rating agencies will probably look through this if they are very clear that this excess is basically going to fund this extraordinary situation, right? And there is enough firepower even for RBI to monetize things further. So that's point number one. On interest rates, I think though the liquidity is extremely high, and you've already seen interest rates and yields coming down. So your PSU bonds, banking paper, the yields have crashed. Like I said, PSU banking and debt funds, just some time back, they were giving you close to 6.5% yield. They've come off to 5.5%, 6%, right? The liquid funds have come below reverse repo. Your ultra funds are between 4 and 5, right?
Right.
Now, on the other side, there will be a lot of supply as well. So because of the higher fiscal deficit, governments will also issue a lot of paper. Now, how much the RBI will monetize, we'll have to see. They've not yet announced how much monetization.
Okay.
I would say, I would argue that you're probably looking at a period this year where the longer term bond yields will be range bound. So between, let's say 10-year would be between 5.5 to probably 6%, right? That kind of range you will see. Now, in that kind of a scenario, I wouldn't advise an investor to go and buy long dated gilt funds. If you still believe that things are going to get worse, interest rates will come down further, it's best played through funds called dynamic duration funds. When the fund manager decides when to take higher maturity papers and when to go lower in terms of maturity. So you're better off there. Otherwise, according to me, today, the best place to be is in these banking and PSU funds, which are, or corporate bond funds, which buy paper in the 2 to 4 year maturity bucket. Because even if you make 5.5 to 6, consider that this year inflation is going to be much lower, right? So the real returns will still be reasonably good, and match your maturity with the underlying fund. So very simple this year. For the people who are a little brave-hearted, right, they can go and buy some of these funds which take a little bit of credit risk, like maybe 20% AA, single A. It's not a bad space, to be very honest. The spreads are very attractive. They are closer to 8%, right? So some part of the portfolio, if you do seek a little higher return, you can invest. Coming to your second question, which was on, I think, frankly,
the liquidity, they are wondering whether the liquidity in the debt market is illusory. Maybe even Mr. N.S. Venkatesh could probably talk about that.
I think briefly Bala did allude to the liquidity aspect. See, I studied all the 6 schemes. I mean, I've not gone into the portfolio in depth, but each of these schemes, right from, let's say, an ultra short to a dynamic accrual, they have different maturities of papers.
Yes.
Okay? So left to their own, that is when I say to their own, basically borrower comes and pays back on maturity, the coupons whenever it's due and maturity. They have given a maturity schedule, right? Those maturity schedules obviously extend longer for the higher maturity funds, whereas for ultra short, let's say 60-70% of the money will still come back in the first 18 months. But like Bala said, as and when the bond market liquidity gets better, and it's all better for the lower rated papers because of the first loss guarantee that the government has given, my sense is over the next year, you should see a substantial amount of these monies coming back to investors.
Right.
For the borrowers to pay them back.
I understand.
They can liquidate the papers in between as and when market is more liquid. Second, all the coupons that accrue, because there'll be a lot of coupons which will accrue every month and paper mature also. They've appointed Kotak as an administrator. So the voting process is over and the investors to their methodology of liquidation, they will fix a date, is what I understand, every month, where they will pay out whatever liquidity has accrued to the fund. And the liquidity can come by way of coupons, maturity, any of the underlying papers which are due in that month, and their ability to liquidate part of the portfolio in that month. So I hope that is clear to
Thanks, Ashish. Mr. Venkatesh, there are some very interesting questions, and you, as being a banker, I think you need to address this. So we have this interesting question from Prakash and Balakrishnan, who say that how safe really are PSU and banking debt funds? And they have specifically asked you to kind of answer this question, that how safe really are, banks, and whether it is good is it safe for mutual funds to invest in these 81 bonds of banks, and whether bank FDs are better than debt mutual fund. And they specifically wanted you to answer that because you're coming from the banking industry, so your perspective. I know they put you on a spot.
No issue, no issue, no issue. We will try and answer the questions to the best
Yes.
possible level. Let me say that the uh, 81 bonds, essentially maybe the regulator will also look at prescribing new regulations for the 81 bonds. Maybe we do not know. The guess could be that it could go only to the credit risk funds and not to the other mutual funds schemes, sort of this thing, so that it clearly indicates that there's a credit risk there. That's sort of. The second thing that can happen about the PSU banks is that PSU banks, at least we can be rest assured that no bank failures will happen. So since no bank failures will happen, because the government of India, there's an implicit sovereign guarantee which is there. So that will be a backstop facility. So there could be mergers and consolidations which could happen, but that doesn't mean that the let us say the bonds issued by them is going to get defaulted. It will not get defaulted. So to that much extent, we can be reasonably sure in the PSU banks category, those sort of things cannot happen. The defaults will not happen. The government will not allow the defaults to happen. Then the third one, can you repeat the question?
Bank FD versus debt mutual funds.
Yeah, the bank
especially for senior citizens. The two people who asked are basically they already have some investments, and Mr. Parameshwar and Shekhar, both of them are wanting to ask whether they should continue with debt fund investments or move to bank FDs.
See, when they put it into the debt funds, they had a sort of a time horizon which they had in their mind. So I think they should look at that time horizon, and then if the funds are performing, they should continue to remain in the debt funds, because on a tax adjusted and inflation adjusted basis, the debt funds give you a superior return than bank FDs. And bank FDs are actually, now the rates are falling down still further, because the monetary policy stance is to be very, very soft. They are cutting rates left, right, and center, and currently the repo rate is at around 4%. So around 155 basis point rate cuts have happened over the last 9 to 12 months period. So if you are looking at it, there is a clear indication that the central bank is saying, one, I will give you liquidity. That is evidenced by the fact that 8 lakh crore of liquidity is there in the system. Then I will make the cost of liquidity also very, very, very low. So both the price of liquidity and availability of liquidity is being assured by the Reserve Bank of India. So if that is the case, then the interest rates are not going to go anywhere up north. It will remain at the current level, or it can fall down still further, because lendings are also not happening at the bank level. So since bank level lendings are not happening, the banks do not require deposits for them to fund anything. So to that much extent, they will keep their deposit rates unattractive. So if in these circumstances, it is better to look for an alternate investment avenue. So the debt fund looks at a better alternate investment avenue.
Okay. Thank you, Mr. Venkatesh. Before we take the last question, which I want to address to Birla, I just have one small question from you as well. This is from my side. And do you think that from the regulator's point of view, this recategorization has to be reviewed? Because in the while they have actually categorized based on duration, there is no limit on the credit risk that probably a liquid fund or a low duration fund or ultra bond fund can take. And is this something that you think the regulator will relook at the categorization per se? And do you think it is high time that we have a segregation, that these funds are only for retail investors and these are only for institutional, much like having a minimum investment cap or something like that? Do you think the time has come to look at these two things?
I think definitely the regulator will be looking at all these things, for the simple reason that we are going through a mini crisis. So to that much extent, definitely the regulator will look at all these things. He has put in a lot of conditions for ensuring liquidity is there in the system. He has also, on the asset side of the schemes, he has given us a lot of guidance. So maybe he will look at the liability side of the scheme as well. So that is where maybe he will say that this is for the HNIs, this is for the pure retail, this is for the wholesale investor. That can happen. So maybe these are all work in progress. We do not know at what point of time the regulator will come out with his final guidelines. But there will always be a consultative process between the mutual fund industry and the regulator, and they have a mutual fund advisory committee as well. So they will really take it through the mutual fund advisory committee, where even people from all walks of life, including advisors, including people who are representing the customer interest, all those people are representatives there. So I think there will be a huge amount of deliberations, and based on that, some changes can be expected.
Okay, thank you so much. Bala, last question, because I thought this is very interesting. We've got from one Mr. Dinesh, and he's saying that, if I look at the Franklin portfolio, which we're coming back to again, but it's an interesting point. So one, of course, he's saying that I've invested over 30 lakhs or something in one single fund, which was supposed to be very low duration, ultra short term fund, and now I realize that there is so much of credit risk in that particular fund. The other thing that he's trying to understand, of course, is again back to the maturity. That when the maturity actually shows 0.5 years, how is it that when they disclose this maturity, how much time it will take for really the money to come, suddenly we see the portfolio having such long dated papers. And this is also the question I wanted to ask you, because after doing the post-mortem analysis it always happens, right? After the crisis, only we kind of look at the detailed portfolio. But then you see that actually the maturity is an average maturity, right? So if a fund manager is following a barbell kind of a strategy, where you invest in very low and very long dated papers, the average still comes out to probably 0.5. Plus, then there is something called the put call option, which is ideally used to calculate the maturity. Now, all that is pretty complex, right? So for me as an investor, if I say this particular fund has 6 months of maturity, is that good enough for me to, assume that interest rate risk aside, that this portfolio is, fairly has maturities of papers around the 6 months, or it could be much higher, than 2 to 3? Shouldn't there be some sort of a regulation that caps that?
Yeah, of course, it's a very interesting observation what Dinesh has made. One fundamental difference in the Franklin Templeton portfolio, while he has been taking credit risk and lower rated paper in credit risk fund, he's also been taking such kind of papers across all his 6 schemes. The reason why he had to look at 6 funds to be shut down for redemptions, because he has spread his risk among many funds. So all the other 6 funds. Therefore, to the extent the low duration funds also get impacted, that has created a common question among everyone: is the low duration fund across fund houses bad? So actually it's not bad. All other fund houses actually are maintaining a little higher credit quality portfolio and low duration funds, and they all have taken risk only on those credit risk funds of those credit which are bound to be taken. But into a specific question on put call, any money managers, when you invest in fixed income schemes, he invests in a period of say 3 years bond with about say 6 months to put. So the money managers can actually take exercise his option of taking back the money at the end of every 6 months. So that's the way I think the instruments are always structured. So he has a leeway to call back the money at the end of 6 months. Suppose at the end of 6 months, he doesn't want to call back the money. He wants to stay invested for another 6 months. He will stay invested for another 6 months. It does to serve 2 purposes. One, for the borrower point of view, the borrower knows that if I keep my interest rate attractive and the money manager is comfortable holding an investment, probably end up getting this money for 3-year period. That's the way he will make an assumption. From lender's point of view, which is basically the investor's point of view, the mutual fund investor, money manager's point of view, he keeps his options open. Suppose he finds rates are attractive to invest in the market, he will exercise the put option. And if it doesn't feel attractive, he will not exercise the put option and continue. So this cycle goes on. Times like today, when the last 1.5 years, when interest rates and credit risk were rising, then naturally any put option, the moment they exercise it, then naturally the borrower will panic, saying, no, don't exercise the put option. I'll not be able to pay your money, or maybe extend the put option for next 6 months. So this is what normally happens in any instrument that issued this kind of clauses. I think in the case of Templeton, the moment it shut down, the put option is gone, money has not come back. And naturally, the next put, if it is not there, the duration of the portfolio will get extended to the maturity period. So that's where I think the pricing, it has an impact on pricing, it has an impact on liquidity. So this kind of disclosures, generally, if you take the instruments, when you say maturity, the maturity will say the actual maturity of the bond.
Okay.
At the same time, from average maturity point of view, you take the put option as average maturity and to the put option to the average maturity. From valuation point of view, you take the put option as for valuation. At the same time, you do disclose that instrument's maturity as part of your security features. But most of the time, nobody will see it. Maybe some regulatory interventions can happen to make this much more, what do you call, disclosed from investors' point of view. Again, my always feeling is more the information is good for the customers, is actually protect the money managers, no doubt. But more the information also may lead to a more analysis, which probably may not give you the right result. So I think what needs to be taken into account is the discipline in which I think the disclosures happen in the portfolio.
Okay, great. I think we can just take one more question. I mean, there are very many interesting questions popping up. If we have time for another 5 minutes, we can just quickly run by these questions. So the one question is, maybe, Ashish can probably answer this. Like you mentioned, banking and PSU debt funds. So someone is asking that, how much of confidence does PSU really instill in you right now, given the current scenario? So would you really go for banking and PSU debt funds is what?
Absolutely. Like, I think Mr. Venkatesh answered it, that PSUs, there's an implicit backstop by the government. So I don't think one has to be really worried about the credit part of the portfolio.
Okay.
Because like I said, one has to reconcile to the lower returns because yields have come off. So today, if you go to a banking and PSU bond fund, you get 5.5% roughly as a yield. Now, after 3 years, you will get something closer to that number because you are basically going into a fund where credit risk does not become a challenge. These are all very high quality papers. Now, 5.5%, it may sound low compared to what we are used to in the past. But the mutual fund's tax efficiency also makes the post-tax returns very, very attractive. 4% is the inflation. You pay 20% on the remaining 1.5, which is 30 basis points, or 0.3%. So 5.2% is the post-tax yield. Whereas today, if you get 5.5% in a bank deposit, especially an HNI who's paying the highest rate of tax, the post-tax returns are far lower and become very unattractive today. So I would say that banking and PSU funds are good.
I have just one question, last question from my side to both Bala and Mr. N.S. Venkatesh. There is this latest SEBI notification that has come in that says that in view of the moratorium offered by the RBI, the issuer of the security, even if he has defaulted, if it is solely on account of COVID pandemic, then the valuation agencies may not consider them as delay in payment. If you could clarify this a little bit more on what really are the implications of this kind of an extension that SEBI has given? I mean, will we see more defaults but not defaults? I mean, how will you judge which issuer has defaulted only on account of the lockdown and not otherwise? Is there some sort of an ambiguity in this kind of regulation that is coming? Maybe Bala, you can talk about it.
Yeah. I think this provision has been made in line with what the Reserve Bank of India has given to banks. The flexibility that is given to the lender in the case of banks, in the case of mutual fund, it's the investor. We are all investors in this particular bonds. The moratorium is being given during the COVID period. If somebody is a good company who has borrowed, but his borrower is not paying the money because of the COVID-related cash flow issues, on such kind of case, what should be done? So money is not being received on time in terms of either principal payment, interest payment. At the same time, he remains solvent. The business remains sustainable. Customer remains credit worthy. But for this 2 months period or 3 months period, is not able to meet his cash flow requirement. And such kind of cases, the mutual funds are given a leeway to restructure it. When you do a restructuring, when we agree for postponing the maturity by say 3 months or 6 months, in the earlier regulation, it comes under the any such restructuring should be considered as default from the point of view of valuation.
Okay.
Therefore, the
Okay.
SEBI actually has intervened and make SEBI regulation also in line with RBI regulation. They have made this provision and given leeway to money managers. In case guys are finding it difficult and any of your bond issuers come to you saying my investors are not making my payment during the period of COVID period. Therefore, allow me to actually give you the payment later by about extending maturity by say 3 months or 6 months. Such restructuring can be undertaken. So far, anything has happened? I don't think anything has happened. But if something comes up, would you just tell them, no, it can't be done? Not necessary. At the end of the day, during this period, there has to be an empathy. There has to be some kind of mutual understanding to ensure the portfolio remains safe in the interest of investors. Therefore, the regulation that has come from SEBI is only enabling provision, giving a leeway to money managers undertake such kind of activities if they find merit in the such kind of ask coming from the borrowers.
Okay, fine. Well, one question they've all asked that you've not spoken much about, we've not discussed much about gilt funds. And Balakrishnan wants to know that whether gilt fund is good enough for the long term. If I can invest for more than 10 years, will I be kind of not taking any interest rate risk? Is that he wants to understand?
Yeah. No, definitely will take interest rate risk. The interest rate risk on a 10 years definitely is high.
There's not doing away with the interest rate risk.
Yeah, absolutely. Any of the mutual fund schemes, there is no guarantee on return, whether you invest in a 30 days paper or a 10-year paper or a 30-year paper. Interest rate fluctuation will happen, credit risk will remain. But I think his question is about, say, he is actually looking at investing for 10-year period. Right. During the 10-year period, definitely the money managers would try to take a call on the market, depending upon whether it's a 10-year paper today to make money, or should invest a 5-year paper to make money for a 10-year. And these are the decisions the money manager will keep taking it. Therefore, if his investment time arisen in his 10-year period, then definitely a gilt fund makes a lot of sense. As I mentioned earlier, the Birla Income Plus example which I gave is not to promote my fund. I give the example. If that fund has seen all the cycles, if somebody has seen the cycles in a 10-year period, will see all the cycles. Money manager will be able to manage it effectively, take an active call and reducing the risk on the portfolio and increasing the risk on the portfolio. Both will happen. Risk off, risk on will keep happening. If that happens, actually the continuous interval, the experience for the investors in a 10-year period will be very good. I think only the risk which is not taking is a default risk. The interest rate risk is taking, but default risk is not taking. To the extent it will be safer on a 10-year period. Naturally, such kind of long period, fixed income would give a reasonably good return for the investors.
Yeah. As much as we'd like to go on with the discussion, we have run past our discussion. Of course, it was a very, very interesting session, and I'm very sure that we covered a lot of aspects. I mean, a lot of things are pending, but of course, it's a very broad topic. It can go on forever. But thank you so much, gentlemen. I mean, Ashish, Mr. N.S. Venkatesh, Bala, of course. I mean, it's been a fantastic session, very vibrant session. I want to thank each one of you for taking time out and joining us today. Of course, I want to thank the presenting sponsor, Aditya Birla Capital, for supporting us through this event. Let's hope that the investors and the participants did gain a lot, from this. I would also like to tell our participants that at BusinessLine Portfolio, we have a dedicated section for MF, which comes out every Monday. We give fund recommendations. We have our own internal StarTech ratings, which is based on very, very, solid algorithms. And we've not, seen any, we've seen most of the top rated funds only picturing there. So please write to us. I know you'll have a lot more questions after this session. So please write to us on this, ID, mf@thehindu.co.in. And we have our in-house mutual fund analyst, almost 6-7, who've been tracking the mutual fund industry for over a decade. So we'll be happy to take your questions and also, forward them to our leading industry experts and take this forward for you. Thank you so much, all of you, for joining.
Thanks a lot, Radhika. It was a pleasure to be on this panel.
Yeah, thank you so much.
Thank you so
much. Thanks, Radhika.
Thanks, Bala. Thank you so much.
Thank you.
Bye.
Thanks.